we recap and kind of get you to understanding where we're at, because, you know, it's cumulative. So we know that so right now we are in this part of accounting for us, okay? So managerial is 202. My accounting majors, you'll deal with the rest, okay? And data analytics is what you're doing in your Excels, hopefully. So you're taking information and hopefully analyzing it. Ethics, you already did the fraud triangle. So we all know what GAAP and FASB are, right? So they're the ones that set up financial. Then we have IFRS for International Financial Reporting Standards. Then we have our conceptual framework, okay, and then all the principles. This should hopefully be pretty easy until you get to the accounting equation. Correct? Are we all on the same page? Okay, no, we're sleeping. Okay, lovely. All right, well, if we're sleeping. So once you know how to handle cash, so right now what you need to know is the accounts, the natural balances, which way they increase and which way they decrease, because if you don't, then you won't be able to do adjusting entries. And that's chapter 3. And so right now, everything is building. So the easiest way, like I told you, is to figure out what to do with cash first, right? So if cash goes down, what are you doing? Debiting or crediting? Debiting. Crediting. Good. Exactly. And then if an asset goes up, what are you doing? Debit. Good. So once you know that piece, then you know what to do with your entries, right? So for example, when we're talking about supplies expense, if we're going to increase supplies expense, is that a debit or a credit? Debit. Very good. Exactly. And then, but if we're increasing an asset, it's a debit. So this is important to have in your Excel, all of these equations and all of the ways that they go up and down. So do we have that? Yes, no, maybe so? Huh? What was that? Maybe not. Okay. So what type of an account is sales revenue? And what balance increases it? Sales revenue is? No. It's equity. Excellent. Because it's a revenue account. So how does that increase? On the credit. Excellent. So do we have this in our Excel? Good. So then you should be telling me properly, right? You should be looking at Excel. So once you go through all of these equations, then you should have a complete understanding of all of the financials, right? What financial is revenue on? Income statement. Thank you. Excellent. Only says it right up here, right? I only like pointed. It's okay. You don't have to talk to me. When you fail the test, then you're going to talk to me a lot. Bloody buggery. Awesome. Okay. What else? So, and we have all of our financial statements, correct? And then we have our ratio, return on assets. Is that clear? So on your Excel, to avoid you having a nervous breakdown or yelling at me, because I really don't like people yelling at me, I usually yell at people, then we have all of the transactions. So if you don't know where something goes, put it in your Excel, because that's going to be your notes for your test. Otherwise, you have to memorize it. And I don't think you want to memorize it. I mean, you should, but that's okay. You know, I can only go so far, right? All right. Then last week, what we did is we started talking about the financial statements. And so then we have some terminology. So hopefully you put this in your Excel in a sheet that says definitions, terms, whatever you want to call it. Did we do that? Or will we do that? You should do that every chapter so it doesn't become crazy, because then you're going to run out of time. Okay. Then we know all of the different accounts that are liabilities. So if you see the word payable, typically that's a liability. Okay. And that means you owe something. So if you have vendors, you have accounts payable and you owe that vendor the money. They gave you either inventory, a service, they gave you something, and you owe it. So in our salaries expenses, right? Once your employees work, you owe them. And usually if you don't pay employees, they don't come back. So you want to pay them, and on time too. Don't mess that up. Don't pull a Veronica. I missed one payroll as a controller, and I'll never live it. And it was right before Memorial Day too. Darn it. Never forget that. So when you see payable, that means you owe it. So if you owe employees, what account would you hit? What type of payable would you hit? Salaries payable or wages payable, right? Exactly. And if you owe taxes, what account would you credit? I really love talking to myself. Taxes payable, right? And so what's the expense? Income tax expense, right? Or federal withholding tax or social security tax, right? Okay. Yeah, okay. And then make sure that you have all of your different accounts. So for example, prepaid accounts is usually one that students get wrong, because they'll see prepaid expenses or prepaid insurance and they'll put that as an expense. Expense is what type of an account? Asset, liability, or equity? Expense? No. No. Do we not have it in our Excel? It's an equity, right? It goes against the accounting equation. I only gave you 3 choices. That's okay. We got all the wrong ones. That's all right. We'll get it right on the test. No problem. Okay. Equity. Expenses is equity. It increases on what? The debit or the credit? Why are you looking at me and not at your bloody spreadsheet if you don't know the bloody answer? Debit. Thank you. Debit? It's not going to come up. It's not going to come in my face. If my face could talk, it would. But awesome. See, equity right here. Expenses, right? There you go. Put that in your Excel if you don't know it. We have been typing things in Excel, I hope. Okay. I hope. Make sure you have the equation all expanded out, right? Revenues minus expenses. They should all be in your T accounts on a good day. Okay. I'm getting worried. So then we have our T accounts, we have that, and then we have our expanded equation, which we talked about. So this is what you want to make sure you have, your normal balances, right? Expenses, normal, is a debit. Debits are always on the left side of the T account. Credits are always on the right. Good. Okay. We'll get somewhere. And then this is what we're going to be doing more of. Journal entries. So you see, we have always debits first, credits last. We always indent the credit, and we always have debits equal credits. It doesn't have to be a one-to-one. It could be a one-to-many. So you could have one account as a debit, and you could have 2 or 3 or 5 accounts as a credit. That's called a compound entry. More than one debit, more than one credit. And we always balance everything, right? We always have a balance outstanding. So you got the opportunity to do that in your homework. And some of you got frustrated because I saw that this morning. And then you have each of your transactions. So in this case, if you always, I would say, start out with what you're doing in the cash side, if you can. If there's cash involved, usually students figure that out first. So if cash goes down, we know it's a credit. If cash goes up, we know it's a debit. So once you know that side, it's a little bit easier to know the other side. Because, yes.
Can you repeat that?
What was that?
Can you repeat that one more time?
Oh, yeah. So if cash is going down, it's a credit. And if cash is going up, it's a debit. So always figure out what to do with cash first. Because usually money talks and cash is king in accounting. And so we love cash. So in this case, if you know you're paying $2,500 for supplies, cash is going down, you know that's the credit. What are you buying? Supplies, that's the debit. Supplies is what type of an account? Thank you. Excellent. Right? And then you go through each of them. Here you're paying cash for equipment. Okay? So in that case, we're debiting equipment and we're crediting cash. Now, if I said we bought equipment on account, what would be your credit? No, because I bought it on account, right? So I didn't include cash this time, but that's,
Accounts payable.
yes, accounts payable. What kind of account is that? Accounts payable is what?
Liability.
Liability. There you go. So it increases on the credit. There, see, we all took a good job. Excellent. So here we see our accounts payable. I saw that, right? So here we bought supplies on account. So when you see it on account, that should probably trigger a payable in your head. Okay? So far with me? Okay. And then here we're looking at the same accounts payable. Let's see what this guy is showing us. Let's see. So this is cash and consulting revenue. So in this case, we are getting cash. So that's a debit. And then the credit is revenue, which is part of assets, liability, or equity? Equity. And it increases on the debit or the credit? Credit. Very good. See, we're looking at Excel. So now let's talk about expenses. You pay your rent at the beginning of the month, right? So is that rent expense or prepaid rent? So today's what? Today's the 18th. Let's assume we're paying it on October 1st for October's rent.
Prepaid.
Prepaid rent. Excellent. Why is it prepaid? Good.
Before it's like, before you're living there. Before it's used.
Right before it's used. Excellent. Yes. So if it's, and now it's October 31st, Halloween, happy Halloween. And now how do we get rid of that entry? Okay, what do we post to? Excellent. I like posting entries. So if it's in prepaid rent, what do I have to do?
You have to debit something.
Yeah, you're right about that. Good job. Yes, we do have to debit something. Oh, let me move this up. Okay, so let me move this back down. So it's right now in prepaid rent, right? How much do we pay rent? $500? What's rent? $500? Oh, that's too expensive?
No, a lot more than that.
Oh, okay, $1,000?
11, 12.
All right, let's do $1,200. All right, so that is $1,200. And then this is my cash account for the $1,200. So now how do I get it out of here? What do I have to do to prepaid rent to remove it? Credit? Yeah, good. So I'm crediting prepaid rent for $1,200. What's my debit? This is as of October 31st, right? Halloween. What did I just use? I didn't use cash this time, right? I used cash at the beginning.
Use the service that you paid for.
Okay, so what is that? That's exactly right. I used something. It's a debit to rent expense. So that's what you're going to be doing in chapter 3. That's an adjusting entry. Adjusting entries come about because of time. Everybody's looking at me confused. Okay, that's not fabulous, but that's okay. We'll get there. That was a good segue into chapter 3. But here's our salaries. So here's our compound entry. So we had rental revenue and consulting revenue. So those two credits equal the debit of accounts receivable. So accounts receivable is who owes you money when it's accounts receivable?
Someone else.
Yeah, who? Customers, right? And then who owes you money in account? Who do you owe money in accounts payable?
Vendors.
Vendors, businesses, exactly. Good, 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 good. See, get that terminology. Good. Here, what somebody paid you, on account, on their account. So what happens if somebody's giving you money? You're debiting cash, exactly. Always figure out if cash is involved, what to do first. Cash is king. And then we have our trial balance that you should have on your Excel. And then we have all of your financial statements that you should have that I did for you and your debt ratio. So that's our review. How much of that do we remember? Or do we feel we know? It's okay if it's like, give me a number. I'm a numbers person.
Like if I couldn't look at my notes.
Oh, so 70 or 80%? Probably. All right, that's good. I like that number.
If I couldn't look at my notes, how much would I be able to remember?
No, you can look at notes. That's okay. You can have your notes for your test.
Probably somewhere between 60 and 75%.
60 and 75%. All right, so we're talking 15%, 2 standard deviations. All right, I'll take it. All right. Anybody feel better than 80%? Not yet. So you need to add more notes to your Excel so that we can get to 80 or 90%. How about that? On a good day. On a good day. Okay. So let's start. All right, so let's start with chapter 3. So that way you know what you're going to be doing here is basically accrual accounting. So remember, so right here, when you see the word accrual, you think of GAAP. What does GAAP stand for?
Early accepted accounting.
Excellent. So now, if you don't have that in your Excel, I suggest you do put it there. Okay, so what we just did with the rent, the prepaid rent, is the accounting periods that we look at, and it's through the passage of time. So typically our adjusting journal entries, which we call AJEs, adjusting journal entries, put that in your acronym list. Adjusting journal entries. Oh, you know what I should put? Well, yeah, here, I'll just put it here. Adjusting journal entries, because that's what this chapter is all about. Okay, so we have 12 months. Oh, yes, yes.
Before that, you said something else also in Excel. What was it? Yeah.
Oh, GAAP. If you don't have GAAP, yeah, generally accepted accounting principles. Yeah, make sure you have that. So have your one sheet of acronyms, and then have another sheet, your definitions or your terminology. So that way, when you get those simple questions on the test, you don't miss them. That would be good. Okay, good. So we have 12 months, 4 quarters. How many weeks are in a year?
52.
52, good. And if I pay you bi-weekly, how many weeks, how many times am I paying you? 26, good. If I pay you monthly,
Oh,
good. Make sure you know that. You'd be, huh?
maybe it's paid month.
Oh, a lot of nonprofits do that. Yeah, a lot of schools. At IUP we get 26, but a lot of schools do just once a month. I would always want to pay monthly because it's less payroll expenses. As a CFO, that's the first thing I did. I always hate it, but it's not my fault. You can't budget, you know. So I was like, not my problem. So here, these two, you're gonna add these two into your Excel. That means you're typing, and you're gonna put those in your terminology. So when you get a question on that, that's what you're doing. And if you do it in class, you don't have to do it later. So accrual basis means that you see, so when expenses are incurred or services are delivered. So it's usually revenues are earned is the easiest way to remember that. And expenses are incurred. Okay, that's the easiest way to know accrual basis. So put that in your notes. And I don't like using red. I don't like red. I like green. Green is the color of money. It's delicious. Okay, cash basis, it's only when the cash is paid. This we do for taxes. Well, we used to, actually, in 2 years. Thanks to the Biden administration, if you make over $140,000 and you save your $22,500 for your retirement, they want to actually tax you on that now. Tons of biscuit eaters want taxes on everything. Hate taxes and loads of taxes. So we have this in our Excel. We typed it. All right, good to know. Excellent. So what you're doing between accrual and cash is whenever the expense is incurred. So like we said, the employee worked or you received the goods for inventory, that's when you owe it. It doesn't matter if you pay it 30 or 45 days later. So that is cash basis. So we used to be cash for taxes. So then as the time passes is when we have to record the expenses, right? Or if the payables. So revenue recognition, put this in your Excel, okay? This is where most companies get in trouble. So for my accountants, this is the biggest audit risk. Because if you are an organization, what are you likely to do? Do you overstate or understate your revenues? Understate.
Or no, you overstate so you can.
You could have less taxes, but we usually have other tricks for less taxes, like LIFO or some deferred tax assets and deferred tax liabilities. Typically, what happens? So revenues are your top line on what financial statement?
Income statement.
Perfect, right? So what is likely to happen? You want to overstate that, right? Because what do we have? We have earnings expectations. So if you're a publicly traded company, what does that mean?
On the stock market.
Yes, you're on the stock market. We could buy a share of stock. That means you're going to give me earnings expectations, which is usually shareholders, right? And so they're going to, and if you beat those expectations, usually the stock goes up. What happened to the top 3 automakers today on their stock? Did it go up or down based on what we talked about on Friday? Yeah, it went down, right? Because they're still in a strike. And what happened over the weekend then during that strike? Secretary of Transportation, as ordered by Biden, is actually in favor of the union, which has never happened, by the way. You're supposed to be impartial as a government. You're not supposed to get involved in that, but he sent Secretary of Transportation to go try to negotiate with the companies. What's the problem? Why do they want the companies to pay more?
They get more taxes than.
They do, but also they are saying that the companies made a big profit and they have to share in the pie. Is that a true statement?
Not capitalism.
It's not capitalism, you ain't kidding. But also they haven't made a profit in what? Well, they've made a profit, but not for the last like 5 years, 6 years. Because what happened? We had COVID issues, right? We had plants going down, we had supply chain issues. So, but that's what they want. They want a piece of the pie. So revenue recognition is that you're supposed to record the revenue when you earn it, which is basically when you've delivered the goods or services. And then the expense recognition is our matching principle. What are we matching? Revenues and expenses. So right now, for our automakers, they're matching the revenue of the sale of the car. Let's see. I learned that Lincoln has like 5 different models of cars. I didn't know that. Did we know that? I didn't even know that. All right, what's the smallest one of the Lincoln? Is it the Coursera or something like that? What's that called? Somebody just bought that. Anyway, so what are we matching to that revenue? What is the expense associated with making the car?
Labor.
Labor's one, excellent, good.
Parts.
Parts, good. Supplies, right? Shipping, the destination charges, all that jazz is what we're matching with the revenue. Good job. Excellent. And so that's why we have these adjusting entries. So these are the 4 types of adjusting entries typically. Put those back. I would add a new sheet in your Excel. That means your fingers are moving. Add a new sheet and call it adjusting, or AJE's adjusting journal entry. And then write these 4 down so you don't forget. You have a deferral of expense, deferral of revenue, accrued expenses, and accrued revenue. So these are your top 4. They're always going to fall into this category, one of these categories. And when you are doing an adjusting entry, there is no cash involved. No cash. You should have already paid the cash previously. So when you're doing you're doing an adjusting journal entry wrong if you have cash involved. That should come first. And typically when we're doing adjusting journal entries, we usually have an income statement account and a balance sheet account. So if it's an income statement account, it's what? Either it's on the income statement.
Revenues and expenses.
Revenues and expenses. If it's a balance sheet account, it could be one of three types of accounts, right? ALLO, which is an owner's equity. Excellent. Perfect. So this is where you're going to spend most of your time in your homework. And so you're going to have prepaid expenses, such as prepaid insurance and prepaid rent, just like we did our entry. And you see the asset here is prepaid rent. That's what we did. And then the expense was rent expense. So if you're doing insurance, it would be prepaid insurance, and the expense would be insurance expense. Did we do the Learn Smart? Okay, good. Okay, so is it making sense? Or it's still gibberish? Okay, still, everybody nodded yes for all three. That's lovely. Okay, or most people did. So here we have prepaid insurance, right? So if we pay $2,400, right? And this was for 24 months that began on December 1st, 2021. So then we fast forward and we record the expenditure as prepaid insurance on December 1st. So we're going to debit for the full 2,400. Because why? Because that's what we paid. Erie Insurance or whoever it is, right? Okay. And then now, as of 12/31, we have $100 for 1 month's worth of insurance has expired. So why $100? Right, so 2,400, right? Divided by 24, 100. We could do that in Excel, right? So then what are we going to do here? We're going to actually take out that $100 from prepaid insurance, not cash. All right, because we already paid the cash the first time. We do not pay more money than we need to. That's how you get fired as an accounts payable person or clerk. So then we're crediting prepaid insurance for $100 and we're debiting insurance expense. Exact same thing we did for prepaid rent, right? So then we have $2,300 and then as our balance sheet account. Balance sheet accounts are permanent accounts. Make sure you know that. Income statement accounts are temporary. Where do we close income statement accounts to? At the end of the year, right, on December 31st, we have a calendar year. We don't have a fiscal year. What do we do with net income? Where do we put net income? Statement of retained earnings. Excellent. So these temporary accounts get closed into retained earnings. What type of an account is retained earnings? Equity. Great. Credit balance. Beautiful. So then you have your general ledger here and your balances. And then here is your journal entry. And it's basically, and make sure you always have a description. I noticed some of you were missing those, I think, in chapters 1 or 2. And then when you were looking in your homework, you just didn't have a description. And that's why it said that it was incomplete. So, and this one is to record. So with the passage of time is how we ended up having to record this expense. Because we already recorded the cash going out when we paid for it. Does that make sense? All right, I see some heads nodding. Okay. All right. Then we did a physical count as of 12/31 that shows us that we had unused supplies equal to $8,670. So what is the $8,670. Is that our ending balance, our beginning balance, or our adjusting journal entry amount? And no, it's our ending balance, right? Because it said at the end is what we have, right? So it said 8670. Words are important in accounting too sometimes. Numbers are fabulous, but words are important. And people are scared for accountants. They are, I swear. I swear. So if you start with the beginning balance of 9720 and then you have an ending balance that I give you because I went and counted all this stuff, then you know you're going to have to reduce it because it's going down and by 1,050. So we did some of these in our T accounts. Would you be able to do this in Excel? Yeah, just a subtraction. Absolutely. That's all it is. Equals minus, you get the amount. The key when you're doing adjusting journal entries is to know what each amount is, because that's where you're going to get confused, right? Because we thought it was the adjusting amount was 8670. So practice, that's all that takes. That's why you have unlimited attempts at your homework. So if you don't get it right the first time, or the second, or the third, you can still do it. So that's my credit to supplies, and then I'm debiting supplies expense. Does that make sense? I see. Perfect. Excellent. So then we have our balances and our journal entry. So if I give you a journal entry like this, supplies expense as a debit and credit supplies, you should be able to put those in the T accounts, correct? Because that's what you did in chapter 2. Okay, so now depreciation. What is the only asset we do not depreciate? Land. Great. So do not ever depreciate land, right? But basically what we're doing with depreciation is a plant asset, which we also call property, plant, and equipment. You should have that in your acronyms list, right? PPE, property, plant, and equipment. And basically we need certain variables, right? So we have here useful lives. So how many years would you say a computer lasts? 5? You're lovely.
Yeah, what does PP stand for again?
Property, plant, and equipment. No problem.
10 years.
No, that's too much. 5 was good. 3 to 5 usually. The IRS usually says 3. So how many years do you think these tables will last? 10? That's good one. Yeah, 10 to 20 years, depending on the wear and tear. Buildings. This building. How many years do you think this building will last?
Decades.
Okay. How many decades? I like it.
You're talking like before it needs a renovation, like to meet like inspection standards.
No, just overall. Like you just bought the building. You just put up the buildings.
Long time.
Okay. 30, 50 sometimes. Yeah. Okay. So that's useful lives, right? So usually the IRS gives us a bunch of options. So furniture and fixtures is usually 10 years. Computers are 3 to 5. Servers, especially blade servers, are like 5 to 7. Building is usually 30 or 50. So that's your useful life. And then we have something known as salvage value. So how much do you expect to get for that asset at the end of that time period? So how much do you expect to get for your computer after 3 years?
Last thing you bought.
True. But more likely than not, 0 is one of the most conservative salvage values. Okay. So this is your formula for Excel. So you should have in your formula sheet, salvage value equals the asset cost minus the salvage value over the useful life. And then on Wednesday, I'll show you how to do that in Excel with a formula. But let me make a note of that. Huh?
We have class on Wednesday.
Oh, no, we don't. That's right. Never mind. It's on Friday. We don't have class on Wednesday because it's business day. So yes, I forgot to tell you that. I forgot. See? Thank you for keeping me honest. You know? But I'm going to still make a note for Friday so I don't forget to tell you how to do that. Cause we'll do a formula in Excel with some data fields, so that way you can look at that. Yeah, so there's no class on Wednesday. I forgot. Okay. So we will probably, not on Wednesday, on Friday. I keep saying Wednesday, thank you. Correct me. I keep screwing this up. So here we have that we purchased the equipment for $26,000. It has a 5-year useful life, right? And the equipment is expected to be worth $8,000 at the end. So this is the cost of the asset, and this is the salvage value. So we would take the 26 minus the 8 and divide it by 5 years. But now if I'm doing monthly depreciation, what do I have to do? Huh? Times 12, right? So 5 times 12, which is 60, right? So we'll do that on Friday because Dr. Paz is spazzing. So see, you got your 26 minus your 8 gives you your 18, and then you divide that by your 60 because you have each month, and then you record depreciation expense and you credit accumulated depreciation. So you do not credit the asset. Okay, write that down so you don't forget and you don't get that wrong on the bloody test. Do not credit the asset. When would you credit the asset? When would you get rid of an asset from your books? Well, you're going to use it up with the depreciation. Yeah, so if you still own the asset, it'll stay there. What happens when you sell your car, right? Then you would get rid of it when you're selling it, or you're getting rid of it, or it's no longer useful, right? So if you had a VHS player, right? We don't do those anymore. We stream everything, right? So that you got to get rid of. So accumulated depreciation is a contra asset account. So make sure, so that's opposite of an asset. So if an asset increases on the debit, what's the natural balance for a contra asset account? Credit, yes, exactly. Okay. So when you take the equipment less your accumulated depreciation equals your net realizable value. NRV, net realizable value. So the passage of time is how you're going to record depreciation, which is showing you the usage of the asset. So make sure you have contra asset. Make sure that you do not credit the asset, because you will see a question like that on your test. And if you take equipment minus your accumulated depreciation, that's your NRV, net realizable value. Good. And that's your entry. And then that's how you show it, or your book value. And that's how you show it on your balance sheet. So you either have equipment less your accumulated depreciation, or you show equipment net. Net realizable value, net book value. Okay. We'll stop there because you guys are all dead. And Friday wasn't good. Mondays are no good. We're really batting 1,000, aren't we? Aren't we? All right, so no class Wednesday because hopefully you get to go to, I think it's in the hub. I think it's from like 11 to 4, and you can see employers. That would be great. And if not, that's okay too. And I will see you all on Friday then.